On March 27, 1980, Wall Street woke up to a nightmare. Two billionaire brothers from Texas had made one of the biggest bets in financial history. They had bought silver bars, silver coins, silver futures, anything tied to the metal. At one point, their silver empire was worth nearly $10 billion. Then, in a single day, it collapsed. Silver crashed, brokers panicked, banks were exposed, and regulators feared that if these two men went down, parts of the financial system could go down with them. But this wasn't just a story about greed. Because the Hunt brothers had been warning people for years that paper money was dying, inflation was out of control, and silver was the only safe place left. Then the market changed the rules, and suddenly, the men who thought they owned silver discovered the one thing more powerful than money: the people who control the game. To understand how two brothers almost broke the silver market, you have to start with their father. Haroldson Lafayette Hunt was not just rich. He was Texas oil rich. The kind of rich where your family doesn't just own companies. They own ranches, oil fields, land, horses, buildings, and entire pieces of America most people never even see. In the 1930s, H.L. Hunt helped build one of the great American oil fortunes. He was the kind of man who turned oil fields into dynasties. By the time he died in 1974, his family was sitting on a fortune so large that newspapers compared him to royalty. But the Hunt family was not some polished Wall Street dynasty. They were Dallas oil men. They believed in hard assets, real things, land, oil, metal, things you could touch. Two of H.L. Hunt's sons, Nelson Bunker Hunt and William Herbert Hunt, inherited more than money. They inherited a worldview. They believed paper money was fragile. They believed governments printed too much of it. They believed inflation was not an accident, but a slow theft from anyone holding cash. And in the 1970s, it looked like they might be right. America was entering one of the most unstable economic periods in modern history. Inflation was rising, oil shocks were hitting households, confidence in the dollar was weakening, and the old financial order was cracking. The Hunt brothers were already rich enough to live like kings, but they didn't want to simply protect their fortune. They wanted to build something even bigger. And their weapon of choice was silver. The moment that changed everything came in 1971. President Richard Nixon announced that the United States would no longer allow dollars to be exchanged for gold. For decades, gold had been the anchor of the global financial system. Now that anchor was gone. To many investors, this was just a technical monetary decision. To the Hunt brothers, it was a warning siren. If the dollar was no longer backed by gold, then what was it really backed by? Trust, government promises, central banks. Bunker Hunt didn't trust any of it. He believed inflation would destroy the value of paper wealth. And if paper money lost credibility, people would run towards something real. Gold would have been the obvious choice. But for much of this period, private ownership of gold bullion in the United States had been restricted. Silver, however, was available. And silver had a powerful advantage. It was not just a precious metal, it was also an industrial metal. It was used in photography, electronics, medicine, jewelry, and manufacturing. So if inflation rose, and industrial demand stayed strong, silver could rise for two reasons at once. In the early 1970s, silver was trading around $2 an ounce. To most people, it was boring. To the Hunts, it was mispriced. They saw silver as the perfect hedge against a collapsing currency. But there was another possibility hiding underneath the trade. Silver was a much smaller market than gold. That meant if someone had enough money, enough patience, and enough borrowed capital, they might not just invest in silver. They might control it. At first, the Hunt brothers bought silver the old-fashioned way. They bought physical metal. Then they bought futures contracts. Now, a silver futures contract is basically an agreement to buy silver at a set price on a future date. Most traders never want the actual metal. They just want to bet on the price. If silver goes up, they cash out. If it goes down, they take the loss. But the Hunts were different. They wanted delivery. They didn't just want paper profits sitting inside a brokerage account. They wanted real silver bars. They wanted the metal pulled out of the market and stored where nobody could touch it. This mattered because in a futures market, every long buyer has a short seller on the other side. If the long side demands delivery, the short side has to produce the silver. And if there isn't enough silver available, the shorts panic. That is how a squeeze begins. By 1974, the Hunts had accumulated tens of millions of ounces of silver. Their buying helped push the price higher, and short sellers began to feel trapped. One of the famous pressure points came when a major metals trader, Richest, was caught short and needed silver to deliver. The Hunts could have made the squeeze painful, but Richest found a way out. He convinced the Bank of Mexico to sell a large silver position into the market. The price fell. The Hunts took a hit, but they also learned something important. They had been right about one thing. With enough silver, they could move the market. But next time, they would need to be bigger, much bigger. After the early squeeze, the Hunts became even more committed to physical silver. They feared that if the government had once restricted gold ownership, it might one day do the same with silver. So they began moving metal overseas. Millions of ounces of silver were flown to Switzerland. And this is where the story becomes almost absurd. The Hunts reportedly chartered Boeing 707s to transport silver bars across the Atlantic. One version of the story even says that during one flight, the silver was loaded around the edges of the cargo hold to balance the weight, leaving space in the middle for a caged elephant being transported on the same plane. According to the legend, the elephant began interfering with the aircraft controls, causing the plane to lurch in the air before the situation was brought under control. Now that story may be too strange to treat as fully reliable. But the broader point is true. The Hunt brothers were no longer just investors. They were physically removing silver from the marketplace and placing it in foreign vaults. And then, instead of calming down, they moved into another commodity, soybeans. By 1977, the Hunts had built a huge soybean position, again using futures. This time, regulators noticed. There were position limits, and the Hunts were far above them. The CFTC took action, and the brothers were forced to liquidate much of the position and later paid a penalty. This should have been the warning. They had already tested how far a family fortune could push a commodity market. Regulators had already stepped in once, but rather than walk away, the Hunts returned to silver with a new strategy. The first attempt had been big. The second would be historic. By 1979, silver was no longer just a hedge for the Hunt brothers. It was becoming a campaign. The price had moved from around $4 or $5 an ounce to nearly 10. Inflation was still a national fear. Precious metals were becoming dinner-table conversation, and the Hunts were buying through a maze of family members, companies, foreign entities, and partnerships. One of the most important pieces was International Metals Investment Company, a Bermuda-based entity connected to the Hunts and wealthy Saudi investors. That foreign backing gave the brothers even more buying power. And this is where regulators became nervous. It was one thing for two Texas billionaires to buy silver because they feared inflation. It was another thing for a web of domestic and foreign entities to accumulate such a large share of a strategic industrial metal. Silver wasn't only used in jewelry. It was used in electronics, photography, medicine, and defense-related industries. If the Hunts controlled too much of the supply, they could distort prices for everyone. Manufacturers would pay more. Jewelers would pay more. Investors would chase the frenzy. Short sellers would be trapped, and the exchanges themselves could be pushed toward failure if too many contracts demanded physical delivery. By September 1979, the Hunt network controlled an enormous silver position. Some estimates put it above 100 million ounces. Other calculations, including futures and related entities, pushed the figure closer to 200 million ounces. The exact number depends on what you count, but the market understood the message clearly. The Hunts were coming for silver, and anyone betting against them was in danger. Once the market realized how large the Hunt position had become, silver took off. In January 1979, silver was about $6 an ounce. By the end of that year, it had exploded. The move fed on itself. The Hunts bought more. The price rose. Their paper profits increased. Those paper profits became collateral. They borrowed against them and bought even more. It was a machine. And as silver rose, the public started to notice. People searched their homes for anything made of silver. Old coins, jewelry, cutlery, tea sets, heirlooms sitting in drawers for decades suddenly looked like lottery tickets. Coin shops and jewelry stores became part of the frenzy. A spoon was no longer just a spoon. If it had enough silver in it, it was money. But every mania creates enemies. Companies that needed silver were furious. Short sellers were bleeding. Exchanges were under pressure. And the higher the price went, the more dangerous the hunt's position became. Because the brothers were not simply holding silver with cash. They were using leverage. Leverage is what makes fortunes grow faster. And it is also what turns a price drop into a disaster. If you buy silver with your own cash and the price falls, you can wait. You still own the silver. You can survive. But if you buy futures on margin, you don't have that luxury. When the price falls, your broker demands more collateral. That demand is called a margin call. And by early 1980, the Hunt brothers were sitting on one of the largest margin call time bombs Wall Street had ever seen. In January 1980, silver reached nearly $50 an ounce. For a brief moment, the Hunt brothers looked like geniuses. Their silver empire was worth billions. The shorts were trapped. The public was buying. The market was panicking. And the brothers seemed close to pulling off one of the greatest trades in history. Then the exchanges pushed back. COMEX introduced new rules restricting silver purchases on margin. Margin requirements were raised. Position limits tightened. Then came the move the Hunts would never forget. The market became liquidation only. In simple terms, many traders could sell silver contracts, but they could not open new long positions. The buy button had been removed. For the Hunts, this was outrageous. They argued that the exchanges had changed the rules in the middle of the game. Herbert Hunt later compared it to a football game, where the referee suddenly says only the other team is allowed to have the ball. And this is the most complicated part of the story. Because the Hunts were not innocent, they had accumulated a position so large that it threatened the functioning of the market. Regulators had a real reason to be concerned, but the exchanges were not perfectly clean either. Some of the people involved in governing the market had short positions that benefited when silver fell. That created a brutal question. Were the rules changed to protect the market? Or were they changed to protect insiders who were on the wrong side of the trade? The honest answer is uncomfortable. It may have been both, and that is what makes this story so dangerous. The Hunts had tried to corner silver, but when the system cornered them back, it did not look neutral. Once silver started falling, the Hunts needed cash. A lot of cash. Every drop in silver triggered more pressure. Brokers demanded collateral. Banks became nervous. Lenders who once treated the Hunt name like gold suddenly stopped answering the same way. The brothers went looking for money. They were rejected again and again. Barclays, Deutsche Bank, Merrill Lynch, Canadian banks, American banks. The doors were closing. This was the fatal flaw. The Hunts had silver. They had oil assets. They had land. They had family wealth. But they did not have enough liquid cash at the exact moment the market demanded it. On March 27, 1980, the crisis hit. The Hunts failed to meet a margin call of roughly $100 million. Their broker began liquidating positions. Silver collapsed. The price fell toward $11 an ounce, down nearly 80% from its peak. Wall Street froze. This was not just a bad day for two billionaires. Banks and brokerages had lent huge sums against the Hunt trade. If the brothers defaulted completely, the damage could spread through the financial system. The old saying became painfully real. If you owe the bank $100, that is your problem. If you owe the bank $100 million, that is the bank's problem. The Hunt brothers owed far more than that. And suddenly, their private silver bet had become a public financial emergency. The day became known as Silver Thursday. And by the end of it, the men who thought they were going to become the richest people on earth were fighting to survive. The Hunts did not disappear overnight. Their names still carried weight. Their oil assets still mattered. And because so many banks and brokers were exposed, letting them collapse immediately could create even more chaos. A group of banks arranged a massive credit line to help stabilize the situation. It was not a government bailout in the clean official sense, but it was a rescue. The brothers were kept alive long enough to unwind parts of their empire. But the damage was already done. Their silver holdings had turned from a source of power into a source of debt. Then came the investigations. Regulators examined whether the Hunts had manipulated the silver market. Lawsuits followed from companies and traders who had been damaged by the crash. In 1988, a jury found the Hunts liable in a case brought by a Peruvian state-owned mineral company, and the damages ran above $100 million. That same year, Bunker and Herbert Hunt filed for personal bankruptcy. Later, they settled with regulators, paid millions in fines, and accepted bans from trading commodities. This was the final humiliation. The men who once controlled one of the largest silver positions in history were no longer allowed to trade in the markets they had tried to dominate. But here is the strangest part. The Hunt family did not vanish. The dynasty survived. Oil, real estate, sports, and other family assets helped rebuild the fortune over time. Today, the Hunt name is still connected to major wealth and influence, including the Kansas City Chiefs. The silver trade destroyed the brothers' reputations. But it did not destroy the family. That may be the most American ending possible. They lost billions, declared bankruptcy, became symbols of reckless speculation, and still remained part of the elite. Hunt brothers' silver story is usually told in one of two ways. In one version, they were greedy billionaires who tried to corner a vital market and got exactly what they deserved. In the other version, they were hard money believers who saw inflation coming, bought real assets, and were crushed when insiders changed the rules to save themselves. Both versions contain some truth. The Hunts were not simply ordinary investors. They used enormous leverage, foreign partnerships, family entities, and futures contracts to build a position so large that it distorted the market. If they had succeeded, anyone who needed silver would have paid the price. But the exchanges were not heroes in shining armor either. The rule changes were extreme, the conflicts of interest were real, and the collapse showed that markets are not pure machines. They are human systems run by people with incentives, fear, power, and survival instincts. That is why this story still matters. Because every financial bubble starts with a believable idea. Silver was undervalued. Inflation was real. Paper money was weakening. The Hunts were early enough to be right. Then they borrowed enough to be ruined. That is the trap. Being right is not enough. If you are over-leveraged, you can be right about the destination and still get destroyed on the road. The Hunt brothers thought silver would protect them from a broken financial system. Instead, silver exposed the one weakness they could not survive. They had billions in assets, but when the margin call came, they needed cash. And in markets, cash is not just money. Cash is time. Cash is survival. Cash is the difference between being early and being bankrupt. So the Hunt brothers didn't just fail because silver crashed. They failed because they tried to control a market bigger than themselves. And when the market fought back, it reminded them of a rule every trader eventually learns. You can buy the metal, you can borrow the money, you can even move the price, but you do not own the game. The billionaire brothers who tried to buy all the silver in the world.